Hey everyone, welcome to this Placer AI webinar, our retail breakdown in April 2023. We're going to get started in just a minute, so bear with us while we give folks another minute to join.
How's our away music? Anything good?
You know what? I don't have any good away music.
Should we go
I
acapella?
do. You know what I do have though?
Backstreet Boys?
I have a poll. All right, we're going to launch this now. So if you're listening, oh, I like this one. This is a new thing. We did this once before, and it makes me so nervous. But let's launch this thing, and then we will get to it again at the end. And then, speaking of polls, Simeon, I'm warning you in advance. I have a surprise bonus question.
Uh-oh.
Get excited. All right. I mean we have enough to get rolling. Let's get started. All right. So what are we gonna what are we going to be doing today? We're going to start off with a quick introduction, like we always do for those of you who are new. And then we're going to break our conversation down into two parts. First is reflections. We're going to look back. And the second part is trends. We're going to look forward. And then, as always, we will take questions. If you have a question at any point throughout the conversation, please send it in utilizing the Q&A button situated at either the top or bottom of your screen, depending on how you have Zoom configured. We will try to get to them within the flow of the conversation or at the end. I am thrilled to be joined today by our longtime friend. I mean, this is, I'd say, our most regular guest at this stage. And our one, I can't say our favorite. Oh, yeah, I can. Our favorite guest, Simeon,
you
managing director and senior retail analyst at BMO. Simeon, great to have you back, sir.
Good to be back. And we talked about this. This is, I think, the first time both of us are doing it from our office. So,
it's a very exciting day.
So this is, I can't promise the tech is going to work, and hope you like my beautiful background, but good to be here.
I'm so excited you're here. All right, quick introduction, everyone. Placer, location data company. How do people vote? We show you how they vote with their feet every single day across the United States. We do that by observing a panel of over 30 million devices. Very critically, this is all de-identified aggregate data, so we are GDPR and CCPA compliant. We then analyze that panel with machine learning and AI algorithms to make estimations on retail visits across the country. We then present that in a wealth of different reports within our platform, and everything from visit counts, cross-visitation, visit share, traffic routes, and a whole lot more. For those of you who haven't seen, also just as an interesting little plug, we launched our site selection tool, which is a big release for us. So if anyone is on the retail side and interested in taking a look, please let us know. But let's dig in. It's April, but this is our first conversation of 2023. And so I will not start with anything other than the holidays, because we talked a lot last year when we would speak about the decision that retailers were going to need to make regarding pricing in that environment. So do they go back to the doorbusters? Do they hold on to the price increases? What did you see from the apparel retailers, and how did it play off in 2022?
Yeah, so, all right. The last time you and I spoke, a big thing that we were pushing was this idea that recession was the key word that everyone was waiting for. Everyone was so positive it was going to be here, and they were using that to explain changes in spending. And I think from our research, what we found was that it was much more of a product-driven variance as opposed to a people-driven variance. And what I mean by that, and just to preface, because I really don't want this, obviously inflation hurts lower income more than it hurts high income. That's just math. Having said that, what we found was this kind of imaginary curve of products where you think about the quickest replenishment items, milk, gas, anything that you need that you couldn't have stocked up on during COVID. Those items people were coming back for, they were buying, and they were supply demand, go figure, inflationary. On the other hand, you think about a Peloton, you think about grills, you think about patio furniture, items that are arguably high income purchases. Those items, the things that you did over purchase during the pandemic, those were actually coming down in both revenues, but also, shockingly enough, they were deflationary. People were trying to discount all that excess inventory. And so what we found and what we were pushing then was this idea that, and I understand it's much easier said than done, but recognize what the right level of purchasing are. Are your revenues down? Or your units down because people over purchased during the pandemic, in which case trying to stuff promotions down their throat isn't going to get you anywhere, or are they down for another reason? And if you're in the former, what at least I was trying to encourage companies to do was recognize that maybe people just had too many scented candles and it would benefit them to hold before promoting. that is what we saw. We are seeing kind of this pivot now into a lot of focus on supply chain, a lot of focus on what is the benefit that I get back. But I think at the end of the day, there will always, for us, be a question about what is the promotional depth? What do you end up giving? What is the cost of driving your revenues?
I mean, it's interesting. It's like part of the acquisition cost, essentially. Another, moving now into 2023, obviously there have been very significant economic headwinds. How significant have they been, especially within the apparel and beauty sector? And what do you expect for the coming months?
So I'm going to caveat with I'm not an economist, so what I'm about to say is totally made up. But it seemed like we were in a period of reverse inflation. So that is my trademarked or in my mind trademarked phrase, reverse inflation. My in-house economists hate me for it because it's made up. So that is neither here nor there. But I think we have all been trained, because most of us haven't lived through true inflation until now. We've all been trained that inflation is a cost input driver. It's what does my cotton cost? It's what are my wages going up? But the reality is, if you think about what inflation actually is, it's okay. So let's use that cotton example. Cotton goes up 5%. The brands, the retailers, you try to pass through 4. Your consumer says, I'm willing to take 3. 3 is the CPI. That's the number of inflation. Inflation is what consumers spend. And so the fascinating part during the pandemic was that we all got price before we got cost. So inventory scarcity in 2020 because of supply chain issues meant that everyone was talking about the best possible chance to be a retailer, because you raised price because you could, not because you had to. And so what that meant was in 2020 and through at least the first half of 21, you had the better margins because you had the higher price. You had the good part of inflation without the bad part. Back half of 21 through now, we started getting the bad part because the cost caught back up. So all of a sudden you had this conversation where inflation went from being higher prices because of lower promotions to being higher prices because of bad things. And so I think that there have been so many macro impacts. Normally, and you and I have talked about this a little bit, but normally, listen, being a retailer is hard. You have to predict demand. For the last several years, you have to predict supply, and that's next to impossible. So I think right now we're watching the signals of cooling inflation, right? We are also obviously seeing the supply chain opening up. I don't think those two things are a coincidence. And you're returning back to a level where retailers are going to have to forecast demand. And that is hard in bad times. It's hard in good times. And that's what makes winners from losers. That is the execution we are going to look towards. So I'm actually hopeful. Obviously, the Fed is kind of all anyone wants to talk about, but I'm actually hopeful that maybe in back half of 23, we can focus more on the micro than the macro. I guess famous last words, but I think the last 3 years have been all about the macro. Now, at least most of those have dissipated.
I mean, it is amazing. We got a question from a journalist talking about, well, now that things are normal again, we're like, nothing's been normal since the pandemic started. It's just been crazy thing after crazy thing, and trying to make sense of where things are at within the craziness. But one area that I think has been, pretty successful amid all this madness has been off-price retail. And there were clearly a lot of things that were working in this segment's favor. But how do you contextualize the performance? How do you kind of understand how well or lacking? And apologies for the double percentages here. That is a typo on our end.
I thought it was my glasses, so good. I'm glad. I assume we'll go from there. But I think, listen, this is really interesting because I do wonder at what point you and I are going to stop comparing to 2019, right? At some point, we stopped comparing to 2007. We just kind of said, okay, 08, 09 happened. Now we have a new normal. I wonder, or at least a new base, right? To kind of parlay off of your point about what is new normal. So I'm looking at that TJ Maxx and Marshalls, both in the mid 8s, and saying that's pretty compelling on a 1 year. The Burlington, the 7 seems much more important to me than the 20 right now, right? I think we need to understand on a 1 year. And the Ross I'm looking at and I'm thinking, okay, how much of that is tied to California pressures, right? So I think there's probably a regional answer in there that you can probably speak to. What I will say is the 3, right? The positive numbers actually are very encouraging. And I don't know when this time period ends. I didn't ask you for the end date, but if this is post the tax refunds and post the stimulus, if we've lapped that and we're still seeing these numbers, I think that's very encouraging for off-price. And if you would have let me click a button on that poll, if I seen these results, I probably would pick off-price.
Oh, that's an interesting one. What do you think won? Again, it was beauty, fitness, discounted dollar, grocery, or off price.
I'm guessing fitness or beauty.
You know what? It was, let's end this. I'll share the results. It was not. It was discounted dollar with 46% of the vote.
With, by the way, a nice bell curve if you turn
Oh my God.
down. That's a very good statistical curve.
We have an audience that cares about the aesthetic. That's super, super interesting. All right, going into department stores, I think I love talking about this with you specifically because I think there's a lot of challenges that this space has faced, and there have been store closures, and that can lead to declines in visits and much more. But there's also kind of this growing recognition, and I think you were one of the counter narratives when everyone was talking about direct to consumer. You were very big on the power of wholesale and why we shouldn't discount that. And you've said that multiple times, even on these webinars. What do you expect from department stores? What do you think needs to happen for this sector to drive a more significant turnaround?
By the way, the most interesting part of this, as I stare at this, the most interesting part is the still negative from March 7th on. Okay. Because if you looked at it, right, we're about to hit this beautiful string of easy comparisons. Mm-hmm. So if you just look at this, you would think we're about to just start taking off. Naturally, that's not going to happen, right? As we think about what happens in reality versus what happens in math. But I think it is interesting as we look at that. My view, or my team's view, because this is very much credit to the work my team has done, is that this report that you and I have talked about forever, that I've sure a lot of people listening in I've spoken to about. We did this report about 2 years ago called D2C is Not All It's Cracked Up to Be. And I sort of became known as the D2C Grinch, which wasn't really true. It wasn't an anti-D2C note. It was an anti-wholesale note. And so it's simply the idea that we have to remember that omni-channel was the term. It wasn't e-commerce. It wasn't direct. It wasn't any of the, it wasn't wholesale. It wasn't store. It was omni. And so recognizing that the right strategic partnerships are great is important. Now, for anyone who I haven't spoken to on this, the quick takeaways of it, we found that mathematically, wasn't an opinion, it was just mathematically, we found that businesses, brands pivoting to direct did not see a relative increase in revenue, gross margin, operating profit, or operating margin. And I said those quickly, they're all contrarian. But I think like what is key here is to understand that by going direct, you may absorb, you may protect your margin, but you also have to own all of your operating expenses. And the department stores that do this well for the brands that have a good relationship are actually a very economic way to not dilute your brand and get healthy distribution. But you have to be clear on who you are and who you're partnering with.
It's a great point of the kind of especially the element of like you have to be clear on who you are, who you're partnering with. I think it's a big piece of that puzzle. Interesting. I'll let this jump in. We got a question, and Simeon, maybe you do know this. I don't have this in front of me. What did year-over-year sales look like over that same time frame? How or at least what we saw in the early part of the year from those same brands? I don't know if you have that available or off the top of your head for the department store sector. If we think about like even let's go, what we saw in the last quarter.
So this year or last year? So give me the time period we're talking about.
So that data was Q1 of this year. So it was January, February, March. That was what it was running through. But whatever the most recent we have. I don't remember when they.
So I think generally speaking, and you'll know this better than I will, but I think generally speaking, March post as we lapped stimulus, as we lapped, as kind of we worked our way through the tax refunds. I think there's generally a view that things came down in recent weeks. So the question is, how much of that is tied to people have gotten their refunds and have used them? The SNAP maybe has run out, or is it just a function of weather? So I think there's a lot of different questions there, trying to figure out what the reason is. I haven't heard of anyone that's incredibly excited about their performance in the last month.
Interesting. Another sector that I think people are probably a little bit more excited about is athleisure. Definitely one of the pandemic winners. Hey, everyone needs their yoga pants when they're working at home. You only need a nice shirt. You don't need nobody sees underneath a certain level. But what do you think is driving this seemingly endless or strong performance? And what do you think they need to evolve to maintain the strength that they've gained when you think of the wider athleisure space?
So first of all, I want to throw in how happy I am that you've added visits per venue. I feel like I've been asking for that for a while. So it's not just visits, but as we think about kind of comping it. So I think that athleisure used to compete against athleisure and athletic, right? I think people who in athleisure very much don't like being viewed as athleisure, but I think they used to compete against each other. So you'd look at this slide and you say it's a zero-sum game between Nike and Lulu. I think increasingly what's happened is fashion is now finding that this shirt, right? The shirt I'm wearing right now stretches really well, right? It's my Roan commuter shirt. So there's your product placement. Like, you've now introduced the notion that you don't just have to wear a t-shirt to be comfortable. And so I think what happens then is this notion of what the permission to wear comfort stretches much further than it used to. And it becomes a question of, do Nike and Lulu compete against each other now, or do they also compete against traditional fashion? So is the next version of the slide, when we do this the next time, are we going to start comparing, okay, how is this performance up against some of the much larger brands that we normally think about in fashion, at the same way that we used to look at department stores versus off price. So I think like that might be interesting. We might be seeing a paradigm shift in terms of who comps against who, like what that pie looks like.
Sure. A question, that's a great point. A question came in, what's the difference between monthly visits and monthly visits per venue? So visits overall, we'll take a look at all of the different locations and how much visits went up. So, and whereas visits per venue, will divide it by the number of locations that there are. So it's one of the ways of helping to align and offset for just rapid expansions or closures. So if we see someone close a lot of stores, obviously visits are going to go down, but visits per venue might actually go up in some cases if they were effective. So that's the difference.
To the extent possible, I look at it as a proxy for comp. Like, I think it's a better proxy for comp. Is that fair?
Yeah, 100%. Fitness. I feel like every time I talk about fitness, I mention a webinar that you and I did together in June of 2020. And it's one of my favorite moments because I think it's always exciting to remember the times you were right. Unlike the time I was wrong when I thought Lululemon was oversaturated in major markets and was going to struggle. But I mean, brick and mortar fitness, has not been killed off by Lululemon, by Connected Fitness and others. It has instead managed to recover quite nicely and do really well. When you look at like the visits that they're seeing, when you think of what your expectations had been, during the height of the pandemic, where do you see this segment going moving forward?
So I don't think so. Right now in the news, there's kind of the articles talking about Lulu actually looking to sell mirrors. So we've obviously seen that, and we know the conversations around Peloton, and you can see conversations around some of the others. And it's easy to say the same way that we said gyms were dead when At Home started. It's easy now to read those and say At Home is dead and gyms are back. And I think kind of both conversations, remember, like, it never swings as far as the pendulum feels, and being hyperbolic is easy, but it's never actually accurate. And so I think what we have to remember is Peloton does still have some version of 2.5 to 3 million paying subscription accounts, and people do like this idea. But I think years ago when Peloton was first starting and when people thought it would take over, you and I talked about, my view has been, it's no different than fashion. It's no different than retail. This magical thing called e-commerce materialized however many years ago it materialized, and everyone said, okay, that's it, stores are done, right? And they're not. I mean, we know the various percentages that e-com represents, and for next to none of them is it the majority, many much less. So I think what we have to remember, and to steal our mutual friend Steve Dennis's harmonized retail, I think it's harmonized fitness too, right? Or omni fitness, or whatever it's going to be, where we have to remember that what was the reason? Where did e-com really win? Well, it won when the only benefit you had was convenience, because there's nothing more convenient than sitting at home in your underwear. But if you had any level of experience, if you had any actual reason, if the store offered you something that couldn't be replicated sitting at home in your underwear, then the question becomes a cost-benefit analysis. I think fitness is the same thing. And so I think what we're seeing, what you're showing right here, for most of them, not for LA Fitness, but what you're showing right here is the off-price version of fitness. You're showing convenience and price. That's a very powerful equation. And by the way, off-price is one of the best regions in sectors in retail, right? It is far off e-commerce. So if you think about that, if you think about Planet Fitness's success, which again is one of the only publicly traded, so we can actually see the data from their revenues, and then we look at your overlaid over here, you look at Planet, you look at Crunch, you look at 24, it's not surprising to me, right? Because I think it's following the similar playbook that we watched happen with e-com.
Yeah, I mean, I think it's a really important point, and it kind of touches on your idea of kind of the pendulum swinging and what we're actually looking at is really significant, because we do have this tendency to hyperbole. And again, connected fitness is the worst thing in the world. No, it's not. It's great and it has an amazing future. It's just, it's not as direct as we think it's going to be. And in the end of the day, there's this element of not over exaggerating a success or a weakness. I think is really important. A question came in about gyms specifically, so let's answer that one before we move on. So it's interesting that the first 4 gyms are considered discount gyms, whereas the last 3 are considered more luxury gyms. Is this another sign that the economy is entering a recession as people pull back on their monthly expenses?
Yeah, so it's a really good question. That's kind of what I was looking at, and I kind of jumped over LA Fitness because I think it's a little bit. I mean, that might be a little bit. We'll start fights here. Maybe that's more of like the department store of like, think about somewhere in the middle where they're figuring out where they go, but obviously the others very much are. And then you've got Lifetime in there. You are still showing everything growing, right? So at the end of the day, and not by an insignificant number, this Lifetime looks tiny because 24 hour is skewing the scale. If 24 hour wasn't on there and we set this against most of the retailers, Lifetime would look pretty strong too. So I think it is worth absolutely trying to figure out, is this a sign of like, it's funny because I think it's a good question. Everyone thinks about it's a low income recession as opposed to a high income, and perhaps where we're seeing the layoffs are would argue actually more in favor of this chart we're looking at. But again, I want to make sure that I'm not explaining the chart. I want to make sure that I'm actually understanding the chart. And it does still seem to me objectively to be showing growth.
Yeah, I mean, I agree with you. I think that's the right way to look at it. I also think there's something about, we've said this a lot, of kind of like a la carte fitness, and it's not just one option. And so I want my Peloton at home for that couple of days a week, but then I want to go to, take a class here. I want to have a budget gym. And so this, whether I build that through multiple experiences or I go to a luxury, a more luxury chain that has all those things internally, I think it's part of the mix.
There is an interesting, I don't know
Yeah.
if you saw it, there is an interesting one that just came in also. Do you guys have, check out the Orange Theory questions. I think it is interesting. I don't know if you have it. I'm just going to guess it's just not in the data.
You know what? We have it in the data. It's still the largest. So it's a question that came in. Is interesting that none of these are more HIT type of gyms that tend to have a much higher cost. I believe Orange Theory is still the largest gym by number of locations in the country. I think premium gyms are doing well. So we've looked at this. I'm a CrossFit guy personally, so I consider it in that category. No, thanks. I appreciate that. And so yeah, we see in some of those chains, there's like, it can be really significant. I think one of the really important elements to remember is a lot of those more edgy, interesting, fashion forward fitness chains, they were in areas that got hit harder. So if kind of work patterns change, visits can drop because people aren't going to their Orange Theory fitness class right before work anymore, or there's been this move. So we have seen some cases where it does much better and others where it's done a little bit less, but it's much more regionally dependent from what we've looked at thus far. All right, let's move on to beauty. This is another segment that's outperformed and done a lot in terms of the way it reaches customers. I think from the partnerships that have been very notable with Sephora, with Kohl's, Ulta, with Target, from like kind of the store to store-in-store concepts. What can the wider retail landscape learn from the success that this segment has had overall?
By the way, this is cool and potentially interesting, and potentially counter to my hypothesis around Ross Stores. Your Ulta Beauty California, Canada, got BMO in mind. Your Ulta Beauty California, if I'm reading this correctly, still seems to be pretty strong. And so I was wondering if Ross was a California, can be regionally answered. So I think that is interesting there as well. But I think you and I talk, after my tangent, I think you and I talk all the time about experience and just kind of thinking through that beauty naturally is a more discovery feature. It's a more replenishment. And I don't know how I feel about this because it comes up a lot, but the notion of kind of accessible luxuries, and you and I joke around, well, not you and I think this was Howard Schultz's comment, but the notion that Starbucks can be a luxury, right? An accessible luxury, I think beauty can be as well. So it has clearly been on a tear. And I think the fascinating thing is, touching on the gross margin comment and the promotional comment, almost every sector has given back the COVID promotional scarcity. It hasn't really been the case at Ulta. So Ulta has still, for the most part, held on to a really nice degree of their pricing power. And the question is whether I need to say ... yet or not. But they have been a huge outlier in terms of bringing people back in and forcing the people to spend what they want them to spend.
I mean, it's very interesting, and I agree with the analysis. I want to, you know what, it's popping in because I forgot to ask you this in the moment, which would have been smarter, but I'm going to do it now because, you know, whatever. It is what it is.
This is my surprise question. I've been waiting. I've been nervous.
No, your surprise question is coming at the halfway point. It's like the halftime show, even though it's not halfway through, but still. You mentioned something about online inconvenience, and one of the things that we've been increasingly grappling with is the focus on convenience overrated? Like, I think a lot of what we heard about in the pandemic and before was people only want convenience. They never want to leave their house. We just want to sit on the couch for the rest of time eternal. And that's clearly not the case. It's interesting. Another friend of ours, Chris Ressa, I was on his podcast once, and he asked me, what's your thing you think that like would, I guess it was the most controversy. And I was like, convenience
that sounds like a Ressa.
Is like the most overrated concept in retail is convenience. Doesn't mean it's not important. It just means it's overrated. Your take?
Yeah, listen, I disagree. I think humans always want convenience. The question is, what are we willing to sacrifice for it? And so to me, it's whether we appreciate or not, every one of these decisions is some internal back and forth. And that's why I say, if the value that you were offering was simply being convenient, right? If TJX only offered convenience and didn't offer this ability to get expensive clothing cheap, they wouldn't do well, right? Because if all I'm solving for is convenience, then e-com wins, which is why Amazon is so big and Amazon has subscribe and save for certain things and not for others. My point would be that all you have to do, though, where I definitely agree with you on, is that convenience is not the be all end all. It is not convenient. I haven't tried. I know you have very successfully, but to get an Hermes Birkin bag is not convenient, not at all. But people love it, right? And people will go to the ends of the earth to get that bag because there's a reason. And so again, that I'm going to keep using your hyperbole here. So we have to think through, I think every calculation that happens, whether we appreciate it or not, because we're not uber rational, is to determine, am I willing to forego the convenience? And that's where it's up to the stores. That's where companies that can give you something, a reason that counters convenience, I think that's where you win. So bottom line, I think everyone loves convenience because we are likely, unfortunately, naturally lazy, but that doesn't mean that that's going to win out. Thankfully, otherwise humanity would be a little bit more bleaker.
I mean, okay, so a question came in that I really like, and it's also just a beautiful segue to talking about malls. So, you know, it says, speaking of premium, luxury performance is up. However, the locations for luxury have narrowed, e.g. South Coast Plaza. What are the implications for all the mid to high price malls just below the level of a South Coast Plaza? I think that question was articulated very well. What are your thoughts?
I think it's directed to you. So you start that one because you look very excited to get to.
I'm so excited about it. I think we talked about this. Was on our trend. RJ Hodavi, who leads our analytical research team, sends out our brilliant Anchor newsletter every Friday for those of you who receive it. If you don't, it's worth checking out. It's on our website. It's amazing. We do a predictions webinar at the end of every year, a retail trends webinar where we kind of look at the year to come. And one of the big things we've talked about in the last year or two has been the mall waterfall, which is top tier malls are doing really well, and they are limiting the amount of apparel and beauty, and they're focusing more on experiences and other types of tenants. And that means that other retailers that would normally be in that mall or in that are now don't have a place to go. And so they're going to be looking at some, malls that are slightly lower. So I think I think the current environment is very difficult and not the ideal one to be checking. But I think as we move forward, and this is not going to be all malls by any stretch, there are many that are going to have really serious challenges and are never going to recover from them. But there are many that could see a resurgence because those retailers need to find a home. And sometimes being the star in a smaller pond can be better. So that is what I think. I don't know if you have any thoughts on that.
No, I agree with that. Listen, I think we all know that the top malls are in no danger. I mean, they are turning people away, right? I mean, they're bidding wars for when there's vacancies. I think the question, and I think it was well articulated, is what counts as top. And I think that's a little bit amorphous. And I think that will speak to your point about listen, when Lululemon decides they want to stop growing, they will show us where the top levels of the malls lie. You know what I mean? Like there are still some exciting companies that have opportunities to grow, and they're helping show us where they are. But yeah, I don't know that I would paint a broad brushstroke and say, okay, here after number 75, you're all dead. But I think after a certain level, it's obviously it behooves you, and that level actually is number one. Every mall probably needs to continue to justify its existence. And so I don't know that it's equally hard. And I think some have naturally, they're born on third, so to speak. But I think they have to remember that it's an everyday battle.
Absolutely. And it's a question of what's to come that I think, we see with like the mall owners that we talk to are like, oh man, these guys are really impressive. You see the way they're thinking, not just about the near term, but about what's coming 5-10 years down the road and how they're adjusting. And so many of the successes that we'll see in a given moment, like, oh, that decision was made ages ago, and they're only benefiting from it in this moment. Another question came in, says, do you believe outlet malls only go down, or visits to outlet malls only go down because of the weather?
No. Listen, I think the outlets were this beautiful thing because historically they were placed really far away. There was no overlap in customer base. You believed you were getting last year's product because initially you were, and before you knew about made for product. And it was just this beautiful channel. And then the answer was simply tied to seasonal trends, right? Am I going to make that trek out there or am I not? I think as off-price has become much louder, as e-com has offered deals much more, I think like there's a lot of that factors that I think impact the outlet center. What I will say is, for better or worse, and maybe it's passed already because COVID effectively knocked it out, but tourism was also a colossal impact for outlets. So you think about the outlet centers, a lot of that was driven by foreign tourists. That business obviously dried up, and it was a very big impact. So I think the question will be that cyclicality or the return of tourist trends, I think would be important to watch as well.
This is another interesting one that came in. It would be curious to know what the commonalities and brands and anchors among the top visited indoor malls. Are there commonalities that you are seeing?
So that's interesting. I'll throw out something because you asked me, but I think you'll have better, like mine will be conjecture, yours will be fact because you'll track it. But I would say they probably are tied to, well, okay, based on nothing, hypothesis. They're smaller boxes that have relatively smaller boxes that have a lot of exciting things. And again, I'm thinking activewear, I'm thinking new brands, I'm thinking access to different pieces, and they probably have an Apple, right? I mean, that would be my hypothesis. They probably were for a while had a Peloton, but I think that's probably more output than input. But that's that would be my hypothesis. If I was to create a series of common denominators, you probably have the answer based on the data.
I mean, the honest truth is I don't have it in front of me, so I'm going to speculate for fun. I think it's a combo of the things you would expect and a rotation of things that would surprise. And so whether that is, the cool digitally native brand, whether that's a really interesting pop-up, that mix tends to define top performers because there's a reason to consistently go. I think, again, like I think you mentioned, place has a Tesla location. It's probably a cool, interesting location to go to, and because of the way that they're thinking. So that's how I would answer it. But it's super interesting. I think to piggyback also on the outlet mall, one of the biggest things that we saw impact outlet mall visits was when gas prices rose. So indoor malls definitely saw a hit, and I think everyone did. But the outlet mall was much more significant because the distance in general that you're going to have to drive to get there was more. And that was something when, in a difficult economic environment, you would think they have a unique advantage. So I think there's a lot of factors that go in. I do agree with you, though. It's a super fascinating kind of format to look at. But now we are at a very exciting moment, Simeon. We're at the moment for the bonus question.
Uh-oh.
I asked earlier this week, what is the biggest challenge facing movie theaters? And because LinkedIn polls would only give me 4 things to ask, 2 options, I only gave 4. The first was A, streaming services. B, that they need new types of content. C, that the experience needs an upgrade. Or D, other. What do you think? How would you answer that question?
So I would guess that most people went with streaming. I was wondering if you were going to throw in, and by the way, my track record on guessing so far has obviously been atrocious, so we'll see. I was wondering if you were going to throw in, we're in a post meme stock era. And I think meme stocks tremendously helped a certain movie theaters traffic. But streaming's there. It's not new. So I'm just gonna go with that for simplicity's sake, but I don't think it's like some brilliant answer on my part.
I mean, you were very close. That was so. What we had about 100
Out
people
of
answer.
three, so out of
Streaming
three without other,
other
I
was
close. I missed one.
other was 5%. Streaming was 36%. New content was 18%, and an experience upgrade was 41%. I think it was an interesting one, and that was today's bonus question.
You know what? I feel like that's asking about people. It's like asking about NPS. Like, what would you do? I want to know, like, if I improve that, if I gave you the nicest, there's some nice movie theaters, how many people are going?
I mean,
I'm sticking to streaming.
I said content. I was like, they need to have like other things because streaming, it can't be only like, how many Top Guns are there going to be? Like, I hope there's a few more, but they can't have one every year.
Yeah.
Now, looking forward, this is one of my favorite trends. The retail media network and its impact specifically on the physical retail location. What is the potential for retail media in the brick and mortar environment?
So you're talking about like trade spend and end caps and all the other ways brands used to pay for product placement?
Sure, but let's include the things like the cooler screens, the TVs within.
I am giving you a hard time. So we just got back from Shop Talk, which you were notably absent from. So putting you on notice there. And a lot of buzzwords, AI, more AI, and retail media. I think there's no question we're at this interesting evolution or interesting point where people are talking about retail media in a big way. And I think it will be gravy dollars for a lot of different retailers effectively, right? I mean, kind of thinking through whether you're an online retailer or a brick and mortar retailer. What I do think is important to remember, though, is the notion of brands paying for placement and paying for some version of see me over here. That's not new. And so what I want to make sure we don't do is we don't bucket this as its own, we don't create it in isolation, right? Because if I were to tell you that my advertising spend for anything is a totally different revenue bucket, and that becomes 100% flow through and it's great, but it's detracting from another channel, it becomes a different conversation. So I think it's very interesting. It's obviously growing. I will point out that, and I believe I'm right. So you can fact check me if not, but I believe in the last month, I think The Gap, having announced a media network, closed it. And so obviously it's not for everyone. And we're looking, and that's why I say you probably have to be a multi-branded retailer in whatever capacity for it to make sense, as opposed to being your own. We talked about Ulta. I mean, we'll see what they do, but it'll be very interesting to watch. What I want to make sure of is that it moves from buzzword status to actually being something that is new and different, as opposed to just a different way of looking at trade spend.
So interesting. You hear everyone booing in the background for you taking down my favorite trend.
It's not taking it down, by the way, just to be clear. It's saying it's very important. It's always been important. We're calling it something different. And if you can find, like, here's what I'll say. If you can find a brand new way to both collect a revenue stream from your brands or from other brands, and the brands can find a brand new way that they believe to be better than affiliate marketing or better than some other version of advertising spend or something that drives their dollars, obviously that's a winning solution. The question is it different than what's going on now?
I do think you bring up something really important, because I think it's not new. And calling it new is a mistake. There are new technologies, there are new potentials, there's ways it's being looked at slightly differently, but recognizing that this thing existed, I think, is super important. We have a tendency to get overexcited with the new. I once had someone tell me all the best tech companies were the first move, the ones who really broke ground. And it was like, you're right, because there was no MySpace before Facebook, and there was no, other companies before Apple. Are
you listening on your Sony Walkman right now? Is that the headphones?
It's the only thing I listen to. All right, we have only a few minutes left, and I want to get to both of the last two slides. So the first is about digitally native brands. Will the wave of companies looking to open physical locations slow? Do you think their approach is going to shift?
I think this is so cool because we're talking about D2C and digitally native companies with stores, right? So I think like at what point, similar to at what point do we stop looking versus 2019? At what point do we just call these high growth retailers? So you've got Vuori on there, right? I'm just kind of looking through, and that is obviously showing the same dwell time as Adi and Ralph. And ironically, their internet time is less, right? So I think what we will see, hopefully, is a strategic rollout of ongoing stores, and the beauty of the way people believe law of large numbers is, even though that's not what it actually means, would suggest that there is incredible growth ahead because they're still relatively small. So as they go from the base, I think there are some brands that have created some really special connection with their consumers that have an opportunity to really roll these out. And so I think that's exciting. I think what would be cool is to see how the dwell time changes over time. Like what was Adi when it was a much smaller business, right? What was Polo when it was a much smaller business? And to see, are these pretty standard of if you can get someone into a store, they stay for 36 minutes, because it is pretty interesting that they are, all 5 of these are relatively similar. I think it's once you've reached that status, you sort of, the execution is sort of up to you.
That's super interesting. And lastly, let's talk a little bit about innovation. I always have Target up here because I think they're among the most innovative, and I love Target. What do you think the most needed innovation is for physical apparel retail? So apparel retailer in the brick and mortar environment, what's the most important innovation?
Remembering that your best channel is selling in stores, right? Remembering that ultimately you pay your rent once, you pay your hourly wage, hopefully with some bonus attached to that. You optimize your inventory. There's no better way to retail. But then obviously internalizing that there's other channels there. So that's my answer, right? It's kind of a BS answer, but that's my answer. The answer that would have been easier for me to give is make sure you continue to have the best technology that you'll need to optimize your inventory management and optimize your CX and optimize and make sure all these different things are there, and have magic mirrors that let you try on your makeup at home and force you to come into stores to get them. I think, listen, the coolest one would be if you could figure out how to create a 3D printer that prints your apparel right on store premises, but you ensure it's too expensive that no one can do it at home. You hear the moral issue there, right? That is a critical danger once you get inventory perfected like that. So I just think at the end of the day, if you're not coming for convenience, one of the reasons you're coming for in a big box department store type of format is curation. Make sure you're a great curator.
I think you touched on the curation, the experience, and the kind of the operational side of it. Can you get people to buy more products by having a great experience and fall in love with your brand? And then can you make sure you get the products to them? And I think that's like a pretty good way. Oh, you need to do it profitably?
Right.
Oh, I thought we could just
worst. That's the Wall Street in me coming out. Sorry.
Apparently profits are important. And with that, I mean, this was, as always, an absolute joy. And, you know, as every time we have you, we always have a super active audience. So thank you everyone for joining us today. Simeon, thank you so much for being here. This is, you know, obviously we look forward to it every time you're here. Look out, we're going to have our next webinars will be coming up in early May. It's going to be led by my wonderful colleague, Ben Witten, our head of real estate. He's going to be talking about office and migration trends, some office and multifamily topics. So please join if those are of interest. And again, everyone have a wonderful day. Simeon, thanks again so much for being here.
Great to see you.
Take care, everyone.